Vetri, thank you very much for making time to come on the Equitymaster Investor Hour. Delighted to have you. I want to kick this off by really starting how we start all episodes of Investor Hour. Tell us where you grew up. Tell us a little bit about that. Tell us a little bit about your home. Your parents. We're just trying to put a mental picture to where you came from and what you ultimately went on to do.
Sure, sure. So I didn't grow up in one place because my my father was with a very transferable job. So he was with an engineering company, and that caused him to sort of move from location to location. So even though my mom and dad both are Tamilian, but I grew up all over the country. I was born in Bangalore, lived in some villages in the vicinity of Bangalore, lived in Gujarat, Haryana, down south, Tamil Nadu. So pretty much grew up all over the country till I was about 8 years old. And then only when I was about eight, at some point, we realized that a traveling circus was not a feasible model for the family. So it was finally decided that because the company dad worked with was, headquartered out of Chennai. So we took a call that, okay, there's a lot of family in Chennai. The company headquarters is Chennai. So one way or the other for him, Chennai will be a magnet. So let's relocate to Chennai. So Chennai became home after that. But what it also meant is that I was pretty much a nomad when I got to Chennai. And in 1978, that was a big challenge because what it meant very simply is that I couldn't speak a word of Tamil. And in 1978 in Chennai, you couldn't get by if you didn't know Tamil. So yeah, it was baptism by fire. I had to sort of quickly get used to at least speaking the language. I never learned to read or write Tamil. I actually did Hindi throughout school, but yeah, that was a bit of a baptism by fire to get used to the idea of talking Tamil. And for me, going to a new place was never a challenge because I'd already done it several times before I landed up in Chennai. But the language was sort of the big change because till then I had gotten by with my English and my Hindi, but suddenly Chennai meant Tamil became a priority. So that was a big change. But then I did all of my school from fourth standard all the way till high school and then college in Chennai. So yes, I mean in that sense, Chennai is home. That's where family is, and that's where my mother is now as well. So that is pretty much
You, you
home.
mentioned you mentioned your father was in an engineering company. Would you mind sharing the name? What company was
Yeah,
it?
he used to be with L&T for most of his career.
Yeah.
So L&T's construction division is actually headquartered out of Chennai. Engineering Construction Corporation is what it used to be called, but now it's just a division of L&T. But the construction group headquarters has always been Chennai, not Bombay.
So that kind of explains why you were in the rural areas because that's where the big plants come up. And
Yeah, so Mangalore, there was, I think, at that point a fertilizer plant under construction. Gujarat, there was a NTPC thermal power plant under construction. Panipat was fertilizer factory. Then outside Bangalore was Chennai, was Kaveri water supply project supply to Bangalore. Then Kalpakam outside Chennai was the nuclear power plant. So yeah, I mean, been everywhere.
wow,
Courtesy Lassen and Tubro.
wow, you got very early on. You got exposure to how it comes up. What about languages? Since you stayed in so many states, did you pick up any other languages along the way?
There was a time where I could speak a little bit of Kannada and Gujarati, but long forgotten. So yeah, I mean, now I'd say at home, even though my dad and mom were both Tamilian, my dad was very fluent in Tamil. Mom is now fluent with Tamil, but she was a Bombay girl, born and brought up naval, father. So they only spoke English at home. So therefore, the language for us at home while growing up was always English. It was never Tamil. So any conversation at home was English. It was never Tamil.
I think the
Which is
anyways
why
thing.
Tamil was such a big change when I went to Tamil Nadu because I'd never heard it at home.
Yeah, but they say that the best time to learn languages is when you're young. You just pick it up naturally. As
Correct.
you get older, it becomes more difficult. So I guess you just probably gotten in the nick of time to pick up Tamil.
Correct. Yeah.
Okay. So and then
I've been away from Chennai now since 1992. So really, for me, more than anything else, it's now Bombay, which is home because I've been here since '92. I got married here, kids grew up here. So yeah, so I mean, to me, Bombay is now home, not really Chennai. Though Chennai obviously has some very strong bonds and connections. Mother, sister, family. But yeah, I mean, Bombay is home. I don't see myself going back to Chennai
you,
as home.
you love the traffic too much in Bombay. Let's just put it that. Okay. Somewhere along this, before I move forward, was your father, because he was an L&T, did he have stock of L&T? Did they have grants then, or were they investing in stocks in all those days? IPOs, stocks, anything?
So dad used to invest in a lot of IPOs, but L&T didn't have any stock options or no, they didn't have anything of that sort at that. It was unheard of in India at that point of time, right? But investing in IPOs, I think, as a culture in India, has been there for donkey's years.
Everyone did it.
So
That's
yeah,
right.
so he used to invest in a lot of IPOs, and I used to see that. And I think some of the IPO investments he perhaps made in my name as well at that point. So I still have those paper certificates with me. But yeah,
Do you remember any names of IPOs from those days? Late 70s, early 80s, I would assume.
Yes, very much. I have stuff. I mean, the one in which I think he invested in my name was Indo Gulf Fertilizer, which is actually a Birla Group company.
Not bad.
But Indo Gulf, subsequent to various mergers, is
It
now
doesn't exist. Yeah.
effectively. Uh, so effectively, those shares converted into shares in Grasim and Ultratech.
Yeah. Yeah.
Yeah, so that one for sure. Then, there were a lot of other stuff like I can't even recollect some Ponni Steel, Dharni Sugar. I think many of them are defunct. They don't even
Yeah.
maybe
I would
trade.
I would go on a limb and actually say that Indo Gulf Fertilizers was actually considered a blue chip those days.
It was. I think it must have been part of the Sensex at some point of time
It was a
in its
pretty
history because there were four horsemen of this old Aditya Birla group. Right, there was Grasim, there was Indian Rayon, then there was Indo Gulf Fertilizer, and Hindalco.
Hindalco.
And
Yeah.
then, of course, some of these other entities got created, including Ultratech got created much later. Yeah.
Yeah. Yeah. Okay, so you had an IPO exposure. When did you get around to making your first investment?
Well, on my own, that would have been after I started working. So
Okay.
that would have been sometime after June of 1992. And I think, now once again, I mean, at that point of time, the IPO market was quite hot. So I think the first stock I bought via an IPO must have been a company called Waterbase. I think it's still around. Yeah, this was the days when shrimp farming was very hot. Right, so
Yeah.
Waterbase was one of the first few shrimp farming companies that came along. I think it was part of the Thapar group, if I recollect correctly. And then in the secondary market, I think the first company I bought must have been 1 or 2 years into when I started working, and that must have been what at that time was Madras Cement, which is now Ramco.
Right. Yeah. Not bad. Yeah. Not bad. Uh, shrimp. So instinctively it comes to mind. Shrimp farming is a momentum play. It's hot. It's cover. Madras cement, I guess, is boring. So there's a little more work involved. That's why you took 1.5 years to get to that. But June 92, you took up your first job and it was in the investment space. It was related to this field.
Uh, well, I took my first job in 1992, which was with the Kotak Mahindra Group. Well, at that time, there wasn't much of a group. It was one company, Kotak Mahindra Finance.
Right.
But I joined the company, and of course, then they determined where we would get posted. Now, it was my hope and desire to get placed in investments. But remember, hiring on campus. So I got hired from Am Bangalore. So the hiring on campus typically takes place, Feb, March, and then you join work in June. And in between these two dates, the security scandal broke out. So by the time we got to our jobs and reported at Kotak, they came, they sort of told me that, look, most of the divisions are don't have any work right now because of the security scam. Kotak used to also be very big in bill discounting, and after the scam, the bill discounting came to a halt. So they said, look, the only division which has any work whatsoever is car loans, and therefore a big bunch of us who got recruited that year from campus, A, B, C, L, Bajaj. I think the biggest chunk of us ended up selling car loans in Kotak because that was the only division which was actually growing quite well at that point of time. Many of the other divisions were either sort of retreat or on pause mode.
Yeah, and this was in Bombay. Was this in Bombay, Kotak Mahindra? So they had
Yes.
the office in that big office in Nariman Point. Was that the office, or they had offices elsewhere
No,
as
no,
well?
no. So I think the registered office is still Nariman Bhavan, if I think even today. So this is a building called Nariman Bhavan, and then on the second and third floors is where Kotak used to operate. The building you might be remembering would either be Mittal Court, which is where
Yeah,
the
the
first
one.
branch came up.
Yeah.
That's where, when it became a bank in 2003, the first branch came up. And then, of course, the headquarters of the company as well as the bank used to be the Baktawar building, which is right next to Nariman Bhavan in Nariman Point. But the original office was second floor and third floor of Nariman Bhavan building.
So car loans. Who would have thought from I am Bangalore, all set to do investments, doing car loans? How was it? How did it go for you?
Well, as I said, I look back and I think it was the best thing that could have, happened to me because it put me into a role that I was certainly not prepared to do. But not in the sense of being resistant, but I just didn't think I was cut out for it. And secondly, it sort of put me into a zone where, I didn't think this was my strength, but because I got parachuted into this role, on day one, I just had to learn how to do it. And perhaps it taught me things about myself that I would not have discovered early on if I had not been forced into that role. So, I most probably, passed out of IIM Bangalore thinking, I'm incapable of ever being in a sales role. I don't know how to do a sales job. I don't know how to talk to customers. I don't know how to persuade customers. But this was the role, and therefore I just had to learn on the job very, very quickly. And I had some top-notch sales guys as colleagues, and they were brilliant sales guys.
Mhm.
So pretty soon, within a year, I learned some of their tricks, and I still don't think of myself as a great salesman, but I learned the basic toolkit, which I don't think I learned while I was at IIM Bangalore. So, in a way, I'm very glad because A, it taught me about operating in a zone which is not your comfort zone. And B, I realized that this is a skill that, I could acquire, I could teach myself how to do it. And, the other thing when I look back over my career now, almost 30 years plus, you're always selling in life. If you're not selling to a customer, you're selling to colleagues. If you're not selling to colleagues, you're selling to your team members. When I say team members, you could be selling to those who are reporting to you. You're selling to those you report to. You're selling to your board. You're selling to, of course, customers. So, selling, I think, is a very core life skill. And I doubt I would have been pushed into it. So I'm very glad I got pushed into it right at the start of my career. And,
Nice.
I now think of myself as competent, not brilliant, but competent.
And to jog the memory of our viewers a little bit, those would have been Maruti esteems and what have you, gypsies and all that those days. Which
Yeah, Maruti 800,
Maruti
Maruti.
800,
Yeah. So it was not called the Esteem. When they launched it, it was called the
1000,
Maruti 1000. Yeah,
1000. Yeah. Yeah.
it was called the Maruti 1000. And then in 1993, the big activity in my car finance career was Maruti decided to launch what they call the Maruti Zen.
Yeah.
And yeah, and when they launched the Maruti Zen, they had this sort of lottery-based booking system, right? So you pay 25,000 rupees and you make a booking, and then the company will pull out a lottery and then decide who gets the car when. And the lottery, in effect, could have been traded, right? So it was very interesting because therefore people came just to participate in the lottery and they were leveraging themselves up. So, today you talk about leveraging up for participating in IPOs. People were leveraging, and in fact, the product we were offering at Kotak at that point of time was if you really want to get the car, Don't make one booking, make 10.
Yeah.
And you'll need 3,000 rupees as interest cost to cover you or whatever that number was. So you pay us that interest cost upfront and we'll fund the booking for you, so that if you get the booking, then you either get the car at a slight premium, of course, because you had to pay the interest. But more interestingly, you can sell the booking, right? Or you can sell the car, whatever. I don't remember the nitty-gritty of it.
Yeah.
And remember, early delivery of the Zen at that point, you could extract maybe even a lakh of rupees if you were able to, get the car early, because everybody wanted it. So it was actually a financial speculation, and we were sort of the financial providers enabling people to make bulk bookings of the car.
Reminds me of the Morgan Stanley Growth Fund IPO, right? Where the
Something like
firms
that.
and the units were trading at a premium. It's amazing how people find ways to trade in the market. Uh, so you spoke of the water base. You spoke of Madras Cements, which became Ramco Cements, of course. Do you remember which was the first big blow up in terms of an investment that you made?
First big blow up in terms of an investment. Actually, a whole series of them, but I would say the worst investment I made, and I knew it was never going to be a particularly great investment. But remember, the IPO markets were very hot at that time.
Yep, yep.
And when the IPO markets were very hot at that time, suddenly these NBFC IPOs looked to be, very, very interesting, right? Because
94, 95, right?
yeah,
If
so
I remember well, yeah.
these companies would come out with an IPO. Then you leverage your book, and you don't have to leverage it too much. You leverage it up 2 times, 3 times, and suddenly the EPS then goes up because you've leveraged it and you got a higher EPS. And now on that higher EPS, you get paid a multiple, and therefore it appeared to me that NBFCs at that point of time were very hot investments. So I must have invested in some 4 or 5 NBFCs during that period. I most probably made money in the first one or two, but I still have a share certificate of a company that's called defunct now, called Interglobe Finance. So I still have the 100 share certificate with me as a reminder that it worked the first 2 times, but didn't work after that. So I think that company eventually went bankrupt and got delisted at some point of time, or compulsorily delisted, more likely.
Today, of course, we have a different Interglobe. Isn't the Indigo holding company called Interglobe?
Yeah, but this has nothing to do with that.
Of course, of course. No, I'm just saying it in the context that we have a different Interglobe today. Yeah. Okay. So this is, you're still at Kotak doing car loans, and all this is passing you by. You missed the Harsha Mehta blowout,
Yeah.
and but you got involved in the IPO, the FIR rush, and the IPO stuff, and all that. Then what happened next? When did you move to the investment side?
So, by mid 93, I'd been doing this car loan business for a while, and then I was getting pretty bored with it. That, okay, I've learned the sales bit, I do the job reasonably well, but, this is not where I see myself being long term. And, thankfully, I had a fantastic boss who ran car finance in Bombay. In fact, he ran it countrywide. And the person he reported to, who is still a director, Jairam, C. Jairam. So he's a director now at Kotak Bank. So he was my, sort of skip level boss, if you call it that. And he was also the person who hired me from campus. So, my boss told me that, look, why don't you sort of go up to him and discuss, is there some other role? I went up to Jairam in 93 and told him that, look, I think I'm done and dusted with this car finance bit. It's not where I see myself going long term. So is there some pathway that you see where, I could do something else? And I think he turned around and said, look, you've done this for a year. The car finance business is, still growing, and we want to sort of expand our operations in Bangalore. So why don't you go there, do that for a year, and then we'll have a conversation after that. So I took him up on his word. I went to Bangalore for a year, helped sort of scale up the car finance business over there. And then in, May, June, somewhere, mostly April or May of 94, he was visiting Bangalore, and he remembered our conversation from a year ago. And he actually made me ride with him in his car to, I think it was either to the hotel or to the airport. I can't quite recollect. And then on that ride, he asked me, what do you want to do? Have you made up your mind? about, are you clear that this is not what you wish to do, and what is it that you would really like to do? And I told him that, look, this is not interesting. What I'd really like to do is be somewhere in the investing domain, because that is what, interested me right through campus. And it so happened that he was not only looking after car finance. Kotak also had a proprietary investments desk, which actually did two things. It gave loans to people against shares, but it also had its own proprietary book where it had investments in its own name. So that was also a division which reported into him. So for me, this was, you know, uh, just perfect symphony. So he turned around and said, "Look, I can move you to that division if that's what you want." I said, "Great. That's really what I would look forward to." And I also knew the person who was running that proprietary investments group, because, as I said, both these divisions reported to Jairam.
Yeah.
Therefore, I knew both these guys very, very well. And he was happy to have me in the investments desk. Rajan, he was my first boss who taught me pretty much most of what I know about investing. And so I moved there in June of '94 and joined him to support him on the investment desk.
And that's when you uh, dive deep into fundamental analysis, etc., etc.
Absolutely. So when I joined him, he sort of first got me started in terms of thinking about, how to analyze companies. And he was a very, very, I mean, he is a very, very bottom-up oriented investor, very sort of diligent in terms of what he looks at, what he chooses to buy, reads annual reports as a pastime. So I learned a lot of that, from him at that point of time. So that would be somewhere around, June of '94, where I started as an analyst supporting him on the investment desk. And again, a lot of this is just serendipity. In life, it's luck, and therefore I always look back with gratitude. And it so happened that in mid '95, Kotak decided that they would get into the mutual fund business. So 1 year into my investing role, supporting Rajan on proprietary investments, Kotak Mahindra decides that they should set up a mutual fund, and they transferred my boss Rajan to the mutual fund as the CIO, right? So I've done 2 years of car loans. I've done 1 year of proprietary investing supporting Rajan. And then in 1995, Jairam turns around and says, "Okay, you've been helping Rajan for a year, but he's now going to the mutual fund. So now you please do this on your own." So again, just sheer luck. I mean, when I look back, the role of luck in all of this is something you just have to be grateful for, because I don't think in today's day and age anybody would, hand over the prop book to a MBA grad who's sort of just been support to the guy running the book for just about a year.
How did it feel like? And if you could talk a little bit of the scale and what you were doing.
So it was a reasonably large size book in that day's and age's context, because it used to sort of move around a bit, because Treasury always had need for money, and very often they would come to us to reduce the book. But it used to rotate anywhere between 100 to 150 crores in 1995, which was in that
That was a lot of money.
era, it was a fairly large number. So it was reasonably large. It was very concentrated in terms of some of the large holdings that we had, but there was also a small trading book attached to it. And that is what I started managing in 1995. So I started doing that in 1995 all on my own. I had one guy sort of helping me, and then of course two people who joined us from one person who joined us from campus, who also joined me as an analyst as support. So he came in 1995, and so effectively a three-member team, essentially managing those investments. So it was great fun, because it was a combination of the book that we had. There were some strategic investments we had to make as part of the group. Because I was doing this, that was the first time in Kotak, I recollect, they had set up some kind of a credit committee. So they said, "Okay, you're doing investments, you're looking at the balance sheet, so you please come in and join the credit committee on some of its meetings." So I was literally sitting at the high tables on some of the credit decisions at that point, because they said, "You have background on these companies and you're anyway doing work on them." So I got some tremendous exposure at that time in terms of just the things that I got to do, the people I got to interact with, and just seeing the way they were operating, not just as professionals, but also the way they operated as leaders, mentoring, guiding, nurturing. Of course, you always get shouted at for things as well, but it was just a fabulous group of senior people that I got to work at Kotak at that point. So I'm very grateful to all of them for the
Any
nurturing
hits
that.
and misses? Any hits and misses from that period that come to your mind?
Well, quite a few, because honestly, that 95, 96 was a very, very difficult time. Money had become very tight. Treasury continuously wanted money back. So, we'd have a position that Treasury would say, we need the money. So you'd have to, liquidate your positions and return the money back to Treasury. And remember, 95, 96 were not very good years for the market anyway, right? So the
96
market
was the
was
Asian financial crisis as well. Was it 96 or 97?
gets more to 97 by the time you hit the crisis. Yeah, but it was already a difficult time. So, money had become very, very tight. This was the time when interest rates were double digit. If I remember right, IDB and ICICI were issuing bonds in 95, 96 period. IDBI safety bonds. I don't recollect what the ICICI one was called, but their rates were like 14, 15%. And imagine the rate at which they were on lending. Tisco had that secured premium note, which again was almost like a 16% rate of interest instrument. So in general, money was tight. It was even tighter than it had been in the previous year or two. And as a result of that, the market was selling off. So it was very difficult to, run the portfolio at that point of time. The portfolio may have done reasonably okay because we had some reasonably, solid names in it. But there was also a target to create book profits, but it wasn't possible to create any book profits. So, if I saw the mark to mark numbers, maybe the portfolio was doing okay relative to a collapsing number. But from the point of view of generating in a proprietary book positive P&L for the company, that wasn't happening at that point.
Yeah. And so what happens is that, you have this Asian financial crisis. You have I think it was August 1998 when Russia collapsed. And then after that, you had the TMT rally and again the crash. Along this period, you were the prop book, and somewhere after this, you moved to the mutual fund. So talk to us about that period, and also talk to us how you dealt with this whole phase, the money you were managing.
Yeah, so the prop book money I managed effectively lasted all of 2 years because I started it, as I said, in 94. 95, I took full charge of it when Rajan, my boss, moved to the mutual fund. So I ran it for about a year. And then by middle of 1996, maybe the third quarter of 96, I actually left Kotak, right? And I left Kotak, and that's why when people ask me, I say there's no easy answer to this. Sometimes you pick a job because you love it. Sometimes you pick a job because it pays you well. And in 1996, I knew that I was going to get married in 97. And that point of time, Kotak's philosophy was it didn't matter which division you worked in, you all got paid the same, right? Which no organization has anymore. Certain verticals of an organization which would pay very differently from other verticals of the organization. But that was Kotak's philosophy at that time. I was getting married, so I was under some degree of financial pressure to, improve my sort of income. And I knew a bunch of friends who used to work at this firm called SSKI. It was a broking firm.
SS Kantilal Ishwaral, I think, used to be the
Kantilal Ishwarlal. Yeah, so they had a tie-up with Smith Court. So they were one of the early brokers to deal a lot with the foreign investors who started coming into India in 92, 93. By the time I joined them, they had broken away from Smith Court, but they were still very, very well established with large foreign institutions as a research-based brokerage house. So literally, you could say at that point of time in India, there were maybe two foreign brokers, one half Indian, half foreign, and one purely Indian broker, which was, of course, SSKI, which had a good organized research setup and providing inputs to institutional investors. So I moved over there in late 96, third quarter maybe of 96, to the sales side, simply because that job was paying me in multiples, forget percentage, it was paying me multiples of what I was getting paid earlier. And that was, too big an attraction going into the fact that I was getting married in 97. So I moved to SSKI 97 in equity sales. Again, interesting job because funnily enough, remember that I just started by saying I hated sales. And now I was actually picking a sales job simply because money was extremely attractive compared to what I was doing. And again, I wouldn't say I was the most brilliant equity sales guy, but it was good because I got to talk to a lot of institutional investors. Right? So I'd obviously learned a lot working with Rajan at Kotak in terms of investing. But SSKI sort of opened me to two further levels in terms of investing. One is the fact that you had this very strong research team, extremely bright bunch of people who are doing hardcore research, meeting companies, creating the models, writing reports. But equally, I was interacting with top-notch global investors. So people from Singapore to Hong Kong to US to Switzerland to the US. And I started getting exposed to the fact that there are multiple ways of investing. And each of these people I was talking to and pitching ideas to came at it with such varying degrees of perspectives, right? And so again, it really opened my mind in terms of going from thinking about what I had been taught in the past, which is there's one way I looked at companies, to realizing that there is one set of data, there is one narrative that I have, but there are people looking at it in so many different ways and so many different lenses. And therefore, it's all very context sensitive. And I think what it also taught me is that there are many ways to skin this cat. It isn't that there is only one investing strategy that works, because I used to talk to Capital International at that point of time, which you would know. Capital is pretty much one of the most renowned global fund houses. And their thought process, they only thought multiples of years. They never thought 3 months or 6 months. And I also had some hedge funds at that time. Well, they weren't technically called hedge funds as yet at that point, but they were quite aggressive. They would be happy to buy something today and sell it, 3 months down the road. Whereas if I had a conversation with Capital, they would say, okay, even if I were to like this idea, it's going to take me 1 year to buy what I want to. So, if you're going to tell me to buy a stock because it'll go up 20%, Vetri, that won't work, because it's going to take me 1 year to buy what I want. So for all I know, I might have to buy the stock 20, 30, 40, 50% higher. But if I do the right company, I'm happy to own it for 5 to 10 years. And I'd never heard that language from anybody in the past. Right. So again, I'm just giving you one example, but each of these people I spoke to gave me very differing perspectives about how to look at investing, and that really helped shape my own thought process. And I would say a lot of the investing reading that I did actually happened in that part, right? When I really started reading a lot more books and seeing
So
how
come to,
people were thinking about it.
so come to think of it, SSKI was your first job where you were actually in a true blue research environment.
Yeah, yeah, yeah.
And I guess that's where your thoughts started getting formed. You were exposed to all these alternate
Correct.
views, ideas, questions being asked, which were dense and which made
Absolutely. And many of these foreign investors, and because these guys had been doing emerging market investments for a very long time, right? Some of them were already in their 40s and 50s, and they've been investing in emerging markets for 20 and 30 years. And again, the importance of management is something that I started to pick up only as I started talking to them, and as I could see the blow-ups happening. Because as 96, 97, 98, 99 came along, we were seeing so many Indian companies go to the dogs. We could see so many of them where their policies, intergroup transactions, all of this were just not holding up. They couldn't be held up in any mirror or to any degree of transparency. And therefore, again, it really sort of taught me a lot about management, integrity, how to think about investment, which was not visible to me in 94 when I was investing in Interglobe Finance, right? It was simple Excel sheet investment, give him 10 rupees, he will leverage it 2x, EPS goes up, and I'll make 25 rupees because he'll have higher EPS 2 years from now.
the exposures helped you, and you got
Yeah,
exposed to like there are many approaches, like you said, right? There are many approaches, many ways to skin the cat. The
yeah,
one you got exposed to, one of them was through the firms like Capital, which are long term, dense, want to understand management, etc., etc. And I guess that's what ultimately led you to do what you did next. But before I think after that, ultimately there was Sher Khan in the middle, which is extension of SSKI.
yeah, yeah.
Ultimately, you came back to Kotak and as the fund manager, CIO. But before I go to that, how did you deal with the TMT swing up and crash? Did this new thinking of looking at management, etc., help you avoid some of those stocks that really burst out there?
I wish the answer to that was yes, but it wasn't. Also because, sometimes when you're in the middle of this stuff and companies are blowing the numbers out of the water, and this I've again therefore learned the hard way, that really the true worth of management only shows up after you've gone through a difficult time, right? When the times are good, and in 1998 or 99 the times were really good, this might sound strange to you, and I'll take only one name. The other name you can just say is many of the XXX. But honestly, in 98 or 99, it was very difficult to tell the difference between Mr. Narayanamurthy
Of
and
course.
company MD XX, company MD YY. They all seemed like they were geniuses. Businesses were growing, right? It was only after you went through the whole setback, the crisis, their business models had to be rejected, that could you see that, okay, this guy really stands out. He's really done something very, very different. He's built a business model which is different. He's given you transparency from day one. They gave transparency before the whole dot-com meltdown happened. So, mistakes made were several, but I'd say it was also partly because during those good times, as I've learned the hard way, you can't tell the difference. Everybody looks like they're a visionary because they're delivering numbers, they're telling you a good story. The what's actually show up only after you've gone through a difficult period and you can figure out who's come out of it. And that's a principle even today I always espouse, that only after you've gone through a difficult period do you know whether this management is what it claims to be.
Sorry if I can jump in and say something over here. Uh, and that is why every bull market has a new set of investors, because they're yet to burn their fingers and hands and learn the hard way. That is not so easy. You have to do your hard work. You have to find the people who, in the previous crisis, what they promised, what they did they come through. And I think that we're going through that another phase in 2022, if you will. Sorry, you were saying. I just wanted to add that because
No,
that's
no,
a such an
that's
important message. Yeah, that's
very valid point. And I'll come back to that to close on just one more issue, but I'll go to what you said about that 1998-2000 period, particularly the massive rally in 99-2000, because if you go back and look at it, Rahul, what you'll see is that the mad rally actually was exactly for a year, somewhere about the first quarter of 99 calendar to about first quarter 2000, maybe end of first quarter 2000. That was the mad. Prior to that, tech was doing well, but it hadn't gone mad, right? And if I look at that period, it was completely bananas because, and I've written about this. I think my portfolio went up 5x in the space of some 18 months. At peak, it must have been 3 to 4x my annual income, right? So you were sort of drunk on how much your portfolio had actually gone up and how much money you had made. And it was really painful when the drawdown came because it went down 80% from peak. Right? So you were like back to square one in terms of the pain that you were feeling. The only good thing for me during that period, and that's why I would say I survived it and many others didn't, is that I never leveraged. And if I remember that period, because I was on at Sher Khan, I was seeing what retail investors were doing. I would actually submit to you that, of course, the serious money was made, while it was going up. But the problem was people were pyramiding. And if you remember how the whole Badla system worked, without going into nitty gritty, it basically allowed you to pyramid very effectively because you were receiving positive mark to market income every, fortnight, right? So you could use that as a source of further pyramiding. Now, what happens as the result of this is that a position which is in the money, by the peak, your actual capital may be down to a fraction. The entire portfolio is nothing but the market income that has been given to you, and you've continued to pyramid, right? So when it unwinds, you might discover that you've actually ended up with a leverage of 5:1, 10:1, 20:1, right? And then you can't tolerate even a 10% drawdown. And I think the serious money was lost because of this. That people didn't realize that they ended up pyramiding. And secondly, into the first leg of the fall, somewhere between March 2000 to September 2000, people doubled down. And that's the thing that I'm most glad I didn't do. I didn't double down. I said, no, I'm not going to borrow. Whatever I had, it's come down, but I'm going to stay put. But people really doubled down into the fall. And then, by, early 2001, the Ketan Parekh episode broke and, everything was just a complete wipeout. So people just got wiped out on the leverage. But, I survived it just about simply because I had no leverage. But the scar marks were there because, Sher Khan was a, sort of VC funded startup. We'd invested aggressively in the brand. We'd invested in technology to create the trading platform. It was only the second trading platform. First was ICICI Direct. Second was Sharekhan, which had a live trading platform. So we'd spent a lot of money. We'd spent on the brand. And then you come into this crisis in 2001. Suddenly, there are no new customers to be found. You're not pulling your weight in terms of the platform. And it was a very messy period. But to cut a long story short, by middle of 2001, I knew that I didn't have a job for much longer because we decided to part ways with the original group.
Mm-hmm.
And it couldn't have happened at a worse time because suddenly my whole life had changed in the span of 1 year. In May 2000, which was, of course, the lovely part of it, I had a daughter. Soon after I had a daughter, 6 months later, my wife, who was well employed with a foreign bank, decided that she would take a break. Soon after that, my parents decided they would relocate from Bombay to Chennai. And so far, I'd been living in home with them because they had an apartment in Bombay. So we went from, double income, no kids, to single income, one kid, no house, and most likely no job. Right? So that's why I say, all market falls eventually are very, very personal.
Yeah,
And,
that's
for me,
well
it
said.
was brutally personal. But thankfully, I called a few people. I called Kotak. I called Mr. Jairam, and he said, look, Rajan has decided he wants somebody at the mutual fund. And, if he's happy to have you, then we are happy to have you. And I'd already worked with Rajan. He was happy to have me. So, it sort of worked out brilliantly. So I didn't really stay unemployed for very long. But yeah, I mean, so in a month or two, I was relocated back. And my wife also took a call that, okay, this is all too, tense. So I'm also going to run a part-time job. I'm not going to call it quits.
Nice. So I want to reiterate something you mentioned. The leverage is very tricky, and I think we are recording this in the end of January 2023, and SEBI has just shared data that 89% of traders lose money. Uh, and I think everyone who's watching this has to be very aware of this. That it's not easy to make money by trading, and if you're trading and you're leveraged, oh, that's even worse. So please be careful of that. What I want to ask
No,
you,
no,
Vetri,
even
is
in 99, 2001, Rahul,
same,
I mean,
same.
we could see customer data when we were at Sharekhan at an aggregate basis, and we could see that the traders were losing money. I mean, there was a brief period where they were making it, but yeah, I mean, that's about it.
So the other thing you mentioned is that that you did not double down, like a lot of people doubled down at that time. So the double down concept can work either way, right? So if you bought a fundamentally strong stock and you're convinced, you've stress tested the idea, you've done your research, and the stock falls. Now the question comes: should you double down on that position or not? How do you deal with such situations?
So that's a good question. I think I got saved from doubling down simply because I didn't have any major savings at that time, and the quantum of fall in the portfolio was such that I didn't have any additional money to put. So my only option was borrow to put, which people were doing. So
Yep.
people who didn't said, okay, let's put little money and we'll double the position by going to the Badla market. So I had never bought any stock through Badla. I was putting cash down and taking delivery, right? But the other option was put 10% money and buy the same position with Badla. That is what people were recommending. That just switch to the Badla market and double your position. I said that's fundamentally leverage, so I'm not going to do that. So that's why it's my inherent sort of bias against taking leverage, which sort of saved me. From a portfolio perspective, Rahul, if you ask me from a bigger context, um, I would say two things. One is for you to increase your stake in a company which is falling. Certainly, by all means, you should do that. And I think as a fund manager, I've done that several times. But you've got to do it for the right reasons. You've got to do it for the reasons that the fundamentals are telling you that these stocks are deserve to be bought. All that's happening is that valuation is getting marked down. Maybe negative impacts are being interpreted as being longer term, whereas maybe in your thought process they're medium term. The only place I would be careful about is in a downturn, don't try to increase the percentage position in your portfolio, right? So I've done it a few times even as an active fund manager, but never to sort of completely bet the house, right? So not to say, okay, here's a stock which is 3% of my portfolio, it's come down a little, now I'm going to double the house and take 3% to 6%, right? 3% of your portfolio, it's underperforming, it's drifted down to 2.5. You pull it back to 3. Maybe the fundamentals are really great. You even raise it up to 3.5, 4. But you don't double down and say, okay, now I'm going in all or nothing, right?
And
And what I've actually learned, just to conclude over there, is that in many of these cases, particularly when I've been chasing what I call the value end of my investment style, um, it's not unusual for me to feel a stock is cheap, and the stock first greets me by falling 30% after I first bought it. So mentally, I've learned how to be prepared for the fact that after I think it's cheap, it's going to fall further. It's going to make me bleed. So be prepared to add more after it, comes down. But once the price starts to, along with fundamentals, give you conviction, don't be too scared of buying on the way up. In fact, I found in many cases, being willing to buy when it came down has helped me. But what has equally helped me is being willing to add more money as you actually got a set of data and evidence which gave you even more conviction that, look, now I can clearly see that everything is getting aligned. Okay.
yeah, so a couple of points over here. One is, let's say you have a stock ABC and you determine 100 rupees is the price. So a lot of people say, okay, let me put 25% of what I want to put because it could move and I'll buy it over time. I don't have to rush. And it falls 30%, let's say in the example you gave, you look at your numbers again, you're convinced, and you say, okay, I can continue to put another 25, 30, 40% and take your position up to 100% of what you wanted. Uh, is the reason that a lot of people do it this way, where they don't double down so easily, or they take their stake up only to the 3% example you gave? Is it because there's an element that the market may know something that you don't? Do you actually factor that in sometimes? Not the final decision maker, but an ingredient in your decision making process?
That could be partly true. It could also be that things are going to take much longer to sort of play out the way you hope for than what you're currently estimating, right? Because you're never going to know why, when, and how eventually the stock responds to the positive stimuli that you believe are valid. Right?
Yeah.
All these three elements you don't know, and particularly the time element, I think, is the one you know least about. And therefore, you always have to have that thing of saying, the window might be broader than what I imagined. So, I start, but I also manage it. The only sort of difference, Rahul, I would point to compared to what you're saying is that from a fund management perspective, I've therefore always approached this as a percentage of portfolio, right? Now, to be meaningful as a percentage of your portfolio, every name will have a different number, right? Because as a fund manager, I'm always up against a benchmark. So if I really like something, a very good starting point for me is that if this particular stock is 4% of the benchmark, I am not even going to make any money unless I'm at least above 4%. So that in a way already has told me that if I want to go in, I actually need to make sure that I'm at least close to that 4% mark. Now, once I get to that 4% mark, I'm in an equal game vis-a-vis the benchmark. Then I can still determine above, below, how much above. Same stock, if it is 30 basis points of the benchmark, my mental model is if you're not buying anything to at least 1%, anyway, it doesn't make sense. But I'd still say then go in, buy 1% and then sort of review what it is. So as a fund manager, typically my threshold has always been that if you're not willing to buy 1% on day one, then don't do it.
Yeah.
And if you're willing to buy 1%, do keep in mind that as it goes down or as you get conviction that this is now working out the way I intended, you may want to move that position even higher. So position sizing to my mind is a very, very critical part of constructing your portfolio, managing it and managing the risk. People don't pay enough attention to it. But most of what I'm telling you here, honestly, Rahul, is more in the context of the way I have managed money. Because remember, I mentioned during the Sher Khan days, I had personal investments. But pretty much once I joined the MF industry, I stopped investing in equities because I just felt, why have a conflict between what I'm doing professionally and personally? So once I moved to the MF side of the business, I stopped making investments in stocks directly, only in mutual funds. And then, of course, my reference point becomes the way I'm managing the portfolio.
Yeah, which is
Yeah,
fine.
yeah.
The second point which I wanted to sort of emphasize what you mentioned is that uh, if you wanted to buy a stock worth 100 and you wanted to invest 100 rupees in it, and it starts to move up, You should not shy away from buying it if it's
Correct.
again confirmed by fundamentals for two reasons. One, it's still valid to buy, so you buy it. Second, your average price is going to be lower than the market price. I think that is something that works against if I can say, the old style Buffett, which is this is my price, so I'm not buying it. Right? You could. I think there is a story, a famous story. Was it Munger narrated, where he says that Buffett walked out of a deal for like a quarter of like pennies because he said this is his price, and in hindsight that was not a good deal at all, right? So yeah, so you have to think of average prices when you're acquiring.
No, no, no. I'm not thinking average prices. I'm just saying, are you able to now see how these valuations make sense as opposed to price? I'll give you a simple example. When I was at the prop desk at Kotak is when the HDFC Bank IPO came. And I think we must have had some shares in HDFC Limited. So they most probably gave us some, I don't recollect the
Preference.
terminology. Yeah, it was some sort of preference. So we knew that we would get X number of shares in the bank. And it was pretty clear the share was going to list ebulliently. It listed well. I think within a year it was up quite smartly, even from that listing price. And we just looked at it and said, oh, this doesn't make any sense. Look at its valuation compared to others. This nonsense number, and we sold it. And I think it took me almost 4 or 5 years to sort of get my hands around how that company was executing, how they were sort of building the numbers. And maybe 4 or 5 years later, at a price which was significantly higher. But I would say between any recommendations that I had at Sharekhan and any portfolio that I've run since then, that company has always been there and it's been a source of career alpha. But if I had stuck to, I sold it at 80 rupees in 1995, now I'll never buy it if it's above 80,
Yeah,
it
yeah,
was my loss, right?
yeah, yeah.
So when you have the facts and when you have the valuation which are then starting to make sense, you've got to be able to change your mind. Too many people get trapped that, but I saw it at 80 now, how can I do it? But if the facts make sense, you've got to be willing to do it.
So it's so interesting you say this. Just the other day we were recording a podcast with Rajashekhar Iyer, and this same point came up there. And I was telling him this is a famous John Maynard Keynes saying, "When the facts change, I change my opinion. What do you do, sir?" Exactly the point you're making, and it's so true, right? If you can learn to sort of imbibe that and make it part of your decision making process, you'll of course make better decisions over time. You go by current facts. Okay, so let's talk about your stock selection process a little bit, right? Take us through on how you look at a stock, and also talk to us about what are the red flags, green flags that you look for, so they can be like real takeaways for the listeners and the viewers.
So again, this is part of the learning journey, and I've talked about this and written about it as well. When I sort of started my investing journey, that was, as they said, somewhere around May, June 94. And the market sort of peaked in September 1994. And if you do a point to point number, Rahul, between the peak in September 94 and the trough of April 2003, which is 9 years, point to point, the Sensex was down 23% over 9 years. I assure you, 99% of the people, perhaps in today's market, don't recollect this, are not even aware of this, right? But that period also taught me another thing, right? That you can have a market which does this, but if you have good businesses which are able to sort of allocate capital well, they are generating a good return on capital, they are throwing up their own cash flow, then it was possible to make money during this 9 year period when point to point the Sensex went nowhere, right? And these were all typically businesses that had demonstrated these sort of characteristics. So, I would say to me, this is a learning which has been there now ever since that period. That eventually, when you are investing in any company, and this is sort of going back to the nuts and bolts of buffet, it eventually comes down to, does the business generate cash flow? Does it have a business which can grow? If it can use that cash flow to redeploy in business, right? So, the business, it throws up cash, it reinvests the cash in the business. That reinvestment is happening at a rate superior to cost of capital. And then effectively you get this virtuous cycle, which now the machine is running on its own. Right. So it's like If you had a balcony at home and you had a pot over there and you put a seed in it, imagine you put a few drops of water, and then after that, between the water and the sunlight, the magic is that the tree is just sort of growing on its own, and one day it becomes a tree, right? So, to my mind, this interplay of cash flow coming from the business, getting reinvested at a rate higher than cost of capital, that's literally very simply the business of business, but it's also the business of investing. And therefore, that's always been the template, ever since in my mind, that if you're looking at businesses, these are the two which really sort of matter. Does the business throw up cash? Are you able to reinvest that cash at a high rate of return in excess of cost? If you can do it, the business will eventually create money. The fact that it is listed is actually incidental, right? Which is what Buffet sometimes says, right? You should not bother. I mean, if the
Yeah.
market were to close down, it should not matter to you. And that's the trick in a business, which is generating cash flow and return on capital. So that's pretty much been my simple sort of two-line thought process of how to look at businesses. But it took me time to get there. This is not, I mean, very honestly, I would say in 94, 95, even going up to 2000 in the early period, honestly, we didn't even look at cash flows very closely. We just looked at P&L, we looked at balance sheet. We didn't even draw up a clear cash flow statement to be able to distinguish between which companies are generating profits and generating cash flow, and which company has accounting profits but may not have cash flow. It's actually having to borrow to even fund its operations, leave alone fund its growth. Right? So this distinction was not very clear to me. And again, I've talked about this earlier, but I think the other sort of eye-popping point for me was maybe somewhere in the mid to late 2000s when I was chatting with somebody about Amazon, because Amazon was getting discussed a lot even at that point of time. And I was talking about the losses that the company was making, and why should it be worth whatever it was worth at that point of time. And the simple question he asked me is that all that is fine, but why have they not raised money for 7 years? Because the last time they raised equity money was 2001. And I said, that's a great question, because if this company is making losses,
Yeah.
why is it not raising money? It should have to raise money. And that's when I went back, looked at the numbers again, and figured that, yeah, he's reporting accounting losses, but he's not only generating operating cash flow, he's generating oodles of free cash flow. So he had an accounting loss, but he was generating enough free cash flow to keep that compounding machine going. So, that sort of further put a filter on top of what I had already understood about cash flow and return on capital in, by 2003. That sort of got reinforced when this person asked me to go back and look at Amazon.
So the point that you mentioned on return on capital is profound, and I think, and I believe that if someone implements it, you're set for better times. But unfortunately, when you talk to people about investing and picking stocks, is the narrative which impacts them more than this kind of thinking. Uh, uh, is there an easy way for someone to do this? How do you get people to think of return on capital? You go to people and talk to them, they'll talk PE, right? I guess PE is it's way down the decision making process. They'll talk a price to book, they'll talk of valuation parameters, not what really the business is doing, right? The price comes into play. Have you found an easy way to sell this to people to become better investors?
I find that it works very well with most of my distributors. Because the first thing I tell them is that you've invested some money in your business to become a businessman, because that's what you are when you are a distributor. And if that business is not generating 15, 16%, why would you not just leave it in the bank as a fixed deposit, right? So actually, most of them intuitively know this. But strangely, when they come to the stock market, they forget return on capital and start discussing all those other, metrics that you did.
Yes.
So so I think once you are able to get that around your head, that it is really the return on capital which drives any business decision, it sort of just simplifies decision making. Just 2 points to sort of add color to that. There are some businesses that always blow out the lights in terms of return on capital. And there are some businesses which have lots more cyclicality in the way that their return on capital sort of behaves. But the way I operate investing, I feel comfortable with both. In one, you sort of emphasize valuations more than you do on the other. But both are equally acceptable ways. I also um, looked at, actually, again, serendipity, stumbled into a McKinsey study which goes back somewhere to about the mid 2000s, which actually looked at what they call the persistency of return on capital in US companies. And to me, that study was very interesting because it actually taught me two things. One, the persistent factor in any business is actually return on capital. It's not growth.
Okay.
Growth is actually an external variable over which the company has no control. They can do good things to try and benefit. That's a separate issue. That's management quality. But the variable they control is actually return on capital. It is not growth. So growth is a subset of what feeds into return on capital. What is intrinsic to the business is return on capital. And that is what the McKinsey study showed, that companies, this is not sectors now, companies who have demonstrated strong return on capital appear to have something going for them such that this becomes persistent. Right? So that is why I always say, I'm not looking at this from a growth perspective. To me, what is really persistent about a company's business model is its ROC. And therefore, that is what is the metric to sort of back. Equally, it may also be cyclical, but then we recognize its cyclicality. And once you recognize its cyclicality, you can build a strategy around that, right? So you effectively buy extremely cyclical businesses when return on capital is destroyed, as long as you know that, look, this company has a debt to equity structure where it can survive the bad period. It is the lowest cost producer, which means everybody else will go bankrupt before he does, which itself should help improve profitability. And when I look back at the last 10 years, I know for a fact that every 4 or 5 years, he hits profitability, which is, forget above cost of capital, it is 2x cost of capital, because that's how he takes care of his entire cycle. So you can use it even for cyclical businesses. But what's very important to remember is that it is ROIC which is persistent. Growth is actually an externality which even management has to accept.
Great. That's a very nice point.
Yeah.
When do you sell a stock?
So no easy answer to that, but as a fund manager, I would say, the first sort of point at which you sell it is really when the fundamentals, going back to what we discussed earlier, are no longer playing out the way you sort of expected. That's honestly, I think, the simplest definition of when you need to get rid of it. And typically that is not a point at time at which I would then tempt to emphasize valuations, right? So the first sort of jump that you do is, it's like a decision. Fundamentals are deteriorating. If they are deteriorating, you don't use valuations to say, should I sell or not sell? At best, they may only determine whether you sell today or tomorrow. It's a very, very tactical decision now to look at valuations. So the primary thing should always come from whether the fundamentals are deteriorating. The other very obvious candidate, but a very tricky one to implement is there a better alternative somewhere else? Right? Because that may sometimes become a reason to say, okay, I'm going to buy this only because this one's fundamentals no longer make sense. The other thing that I've learned the hard way, there's no simple formula to this, is that I'm always worried about what I call the triple P. Right? If you are at peak margins, and simplify peak operating margins, not return on capital. If you are at peak growth, right? So again, the kind of growth rates you're experiencing now are radically different from anything seen in the past or anything that you believe is sustainable, and you are at peak valuation multiple compared to peers, you're at peak multiples compared to your history, you're at peak multiples compared to, okay, I'm looking at this company in India, but what's the equivalent trading in US or trading in Europe, and at its peak, where did it trade? So you sort of do a base level comparison. So if you hit this triple peak of peak growth, peak margin, peak valuation, then I think it's best for you to say, not my cup of tea anymore. It's time to sort of exit.
Okay, interesting.
The other sort of allied part, Rahul, I would just say about selling decisions, and this comes again from my style and the way I have managed portfolios. I never think of them necessarily as a binary decision. The cyclical businesses that I described, they could be slightly more binary, meaning your position is 0 or it is 1, right? It's a binary outcome.
Yep.
But in the stocks where return on capital is persistent, you sometimes want to act more like a business owner than by the Graham philosophy of margin of safety. And being a business owner sometimes means maybe you make the valuation risk manageable for yourself by managing the position size rather than by saying 0 1. Because, the errors of uh, commission that I see in my own career over 30 years is the stocks where I just exited too early because I didn't have any imagination whatsoever. Now, I doubt I would have let them go from 3% of my portfolio to 10% to 20% to 50%. Anyway, I'm running a mutual fund. I'd have most probably held it if it was a position a 3 to 4, but at least I would have stayed in the business, right? So, position sizing is a very good way to manage risk when you're talking about high quality businesses. But even there, the PPP is something you should be worried about. The triple peak is staring you in the face, then you need to be a little bit more aggressive.
Yeah. Do technicals play any role in your decision making on when to exit a stock? Some momentum indicator, some trend lines being broken.
No, I would say very significantly. Um, but I should rewind here. When I did my prop trading days, and I said there was a trading book, I will say that if you're running a trading book, there is no intelligent way to trade except for looking at some technicals. Now, whether you choose to look at momentum, you look at trend lines, you look at moving averages, that's your call. But trading requires a system. That trading requires a system which may be a combination of certain technical indicators along with some mechanical rules. When you come to slightly more long-term investing, I have found that set of sort of approaches doesn't translate very well over here. So I would still most probably by habit look at a chart, but typically I no longer look at it for a binary outcome. All I'm looking for is a slight edge in terms of saying, what is the story telling me? Is it telling me on balance, okay, you want to buy this today, but maybe you should just be taking your time over the next few days rather than doing it today? But I use it more as a very tactical tool in terms of just seeing what story is the chart telling me. And it's also interesting because sometimes the chart might show you something that intuitively you've not realized when you were looking at the fundamental story in both directions. So, but I suspect many people don't do that, but I sort of learned to look at charts during my prop trading days. So I've learned to keep that in the background, but can I not look at a stock chart? The answer is no. I will pull it up at some point and say, let's see what this story says.
Yeah, of course. Uh, uh,
and it's also sometimes, so if you just look at where a stock is on a very long-term chart relating to moving averages, and also if you look at valuation charts, not just the price charts, I think that is the best way for you to understand. If I think I'm being contrarian here, is the chart telling me that I'm contrarian, or am I just kidding myself that this is a contrarian opportunity? Because sometimes the chart really tells you whether you're dealing with something which is contrarian or not, right? You can see how long it's been in the drawdown, how persistent that drawdown has been. That sort of helps shape your own thought process, right? So last thing you want to do is buy a stock just because it's down 10% today saying, oh, I'm contrarian. That's not contrarian.
You said valuation chart. What do you mean by valuation chart?
Yeah, so I've had this discipline ever since I've used Bloomberg. So through all my different roles, firms, I've used a standard set of valuation charts, which just sort of plot the history of the stock in terms of its price earnings multiples, its price to sales multiples, price to book multiples. So you just get a sense of, I think I'm being contrarian, but then you look at the price to book and you realize, hold on, this is like the top 25% of price to book in the last 10 years. So who are you kidding?
I just revealed I don't look at charts at all, by the way. So that's aside. Okay. How do you, so we've spoken a little bit about this, of course, the cash flows and all, but how do you detect fraud? And how do you try and protect your investments, your funds investments from a potential fraud case?
So, good question, Rahul. I'd say one, the minute you start looking at cash flow ROC, you've already sort of raised the bar to a level where many of the potential frauds start getting eliminated. Because you are emphasizing a company's ability to convert profits into cash, you are emphasizing their ability to use cash to grow. Not that we are against companies that use debt to grow, but it becomes part of your hygiene set that what am I looking for? right? The other things that you look for, which are typically visible in the balance sheet and the annual reports, related party transactions. And I think on that front, the level of disclosures has improved dramatically from when I started my career. So, I think things are a lot better today in terms of ability to see where the transactions are happening. As an institutional investor, our ability to even vote against some of these transactions in some cases and prevent them from happening. So, that's a very important part of where you see related party, quality of the auditors, the qualifications that are coming through, um, uh, 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 the sort of promoter remuneration, and how that's flowing through in terms of how they've structured it. So I'd say all of this, along with like it or not, right? I mean, if my wife or my mother, whoever important person, I'm not very good at the kitchen. I mean, they can cook a fabulous dish where they don't have to measure ingredients, right? If they're putting salt to it, they can pick it up with their 2 fingers and add it, and they still know it's the right quantity of salt.
Perfect. Yeah.
If you ask them how many grams it is, they most probably don't know the answer. And I think a lot of management reading is also partly, eventually, in that sense, is a little bit of art. Right? Are you getting that comfort in terms of what they are saying, and does it add up? And I think the most important part of this is too many people, including me when I started my career, get carried away with access to management. Right? If you haven't done the due diligence of seeing what the past data tells you, you will never be able to ask management effectively, why is this not likely to happen, or why do you think this is likely to happen? So I would say it's essentially a focus on numbers, a focus on the past, and which is why I'm a confessed. I don't like IPOs. I normally avoided investing in most IPOs when I've had a choice for many, many years, because I feel in IPO companies I don't have an edge. There's not enough historical information available. There's at best 2.5 years of sketchy information before you make that investment, and you learn a lot more about the company as you keep meeting them and keep understanding, are they consistent, are the metrics they talk about consistent. So I would say, you can do all these things, but eventually there is that pinch of salt, which is judgment. There is no single methodology which will tell you, who's good and who's fraudulent. But cash flow, I think speaks for itself.
Yeah, there's a
And
pattern out there on the cash flow. I think a lot of the scams that we all remember going back
all cash flow.
all cash flow. It's someone just had to look at the cash flow and say, "Oh my God, this is not adding up,"
Yeah.
and stay away.
So if you remember, I mean, if you remember the Watergate scandal, right, in the US,
A little bit.
where Nixon lost his
Yeah,
job, eventually had to step
yeah.
down as president, right? So I'm forgetting the names of the two journalists who tracked down that
Wood-
story.
Woodward, Bob Woodward,
The Bob Woodward,
and
right?
second one I don't remember.
Yeah. So when they're trying to figure out, how to figure out who was responsible and where this connection goes, the words of their editor are actually applicable to investors. His simple message to them was follow the cash.
I don't remember this. I should.
This was the one single line of
Wow.
advice their editor
Superb.
gave them, and this is how they cracked the case, right? Because they follow the cash.
Wow.
So I think that is very useful for any investor to sort of identify where there is, potential fraud, along with the other thing, quality of auditors, related party transactions, all of those.
Now let's talk position sizing. One of our points of discussion on every investor are, you referred to it, you've spoken of it, in the context of a mutual fund, but you, of course, you're an individual. Talk to us about how people should think about position sizing.
So first question to ask yourself is, why are you in the equity market? Is it to take a exceptional level of risk, not even exceptional, perhaps a humongous amount of risk,
Extraordinary risk.
and get extraordinarily rich? Or are you just coming here to achieve your financial goals? Right? Now, unfortunately, too many people take the wrong message over here. Oh, look at Bill Gates. He got, fabulously wealthy. But of course he did. He owned only one stock, right? But what did he do when he got wealthy? He started diversifying away from Microsoft stock, right? So the thing that gets you rich, and the richest people in the world have become richest by owning a single stock, not by owning a diversified portfolio. Now, if you're going to presume that therefore that is the route to riches, I would say be very, very careful. For every one successful businessman, there are 100 we don't write about who have failed. And they failed because all their wealth is in one business, right? So why are you coming to the stock market? If you want this method of, I want to be the next Bill Gates, I want to be, or even for that matter, he's no longer with us, but India's most reputed, I think, sort of self-made investor, Rakesh Jhunjhunwala, going back 2 years, if you saw his portfolio, 80% of his net worth was in 3 stocks. He was more businessman in terms of being able to have disproportionate wealth of his in a few firms rather than having a diversified portfolio. But that was okay for his risk-taking appetite. How many people have that kind of risk-taking appetite and are willing to accept the kind of outcomes? Because for every Mr. Jhunjhunwala, I kid you not, there are thousands of wannabe people who never achieved the success he did. But we don't write about them. We only write about those who've been successful, and therefore, as they say, the stories are only written about those who hunted the lions. The lions have not written their own stories.
Yeah.
So this is the truth, and
history belongs to the victors. What is the statement?
Yeah, same. So therefore, to my mind, what most people first of all need to wake up to is that why have you come to the stock market? Now, if you want to play the game that Rakesh ji played extremely well, and I think he showed you how successful he could be, then you're in a different category. I don't have any advice to offer you. I've never tried that. I don't know how to do it. You could look at what he's done and try it yourself. But if you're in the other category, where you're actually looking at this saying, look, I've got a source of income. I need to use that source of income to build up a nice nest egg for myself, something which will let me enjoy the pleasures of life, the luxuries of life, so on and so forth, whatever they might be. Then I think you need to come at this very differently. You need to have a more diversified portfolio. It needs to be diversified across asset classes. It needs to be diversified across styles. It needs to be diversified across market caps. It needs to be diversified across holdings. You can't have a single stock being 60, 70, 80% of your portfolio. You won't sleep well at night. I mean, what happened to me in 2000 when the markets came down, I said 80% drawdown. Very simple. 2 stocks were 90% of my portfolio at peak, which is why the portfolio came down 80%, when the market came down 40, right? So to my mind, therefore, that position sizing becomes important. We can again debate the right number, but I would say typically most people need anywhere between 20 to 30 stocks in their portfolio if they are doing it on their own. As mutual funds, we have an added complication. We've got to give you daily liquidity. The amounts of money we are managing is very, very large. So, I'd say for us, that number is more like 30 to 70. And typically 50 to 70 is what I would say. But for an individual investor, you could argue 20 to 30 is acceptable, but you've got to manage positions, because will you be comfortable if one single stock out of that 30 becomes 20% of your portfolio, 30% of your portfolio? It all sounds very good when it's going up in the direction you like. The way to think about this is that if the stock falls 30% tomorrow, how are you going to sleep at night? If you're not going to sleep well at night, then don't own 30% of a single stock in your portfolio. So the math of position portfolio sizing, Rahul, actually comes down to what will allow you to sleep well at night for most investors.
Yeah.
Because 50% in a single stock, 30% down for whatever set of reasons. And in history, you see so many stocks have 30% drawdowns during a 20-year period where they may have gone up 100x. But you will find multiple 30% drawdowns. Now, if you can't handle that, then it's too much. So really the first test is how much. But I would say typically, anything more than 5 to 10% in a single stock or above 10%, you're starting to deal with volatility which you might not be very comfortable.
Yeah. Okay. That's a great answer. On asset allocation, you mentioned diversify across assets. You gave the example of Bill Gates. Bill Gates, I believe, is now the largest owner of land in the US. So a person who made all his wealth from the stock market, everyone wants to be that single company hero, but it turns out Bill Gates is putting all his money in land, right? So what do you think of other asset classes? And if you can maybe share your personal experience, how do you like to diversify and how you think about diversification across asset classes?
So you concentrate to get rich, but that's also a very quick route to losing your riches, and you diversify to stay rich. So rich is a word. So let's say you diversify to sort of keep your lifestyle and your sort of well-being where you would like it to be, right? So concentrate to get rich, diversify to stay where you are. That's the simple principle. Across asset classes, well, I went into the late 90s thinking I was a 100% equities guy. I learned in that 2001 meltdown that I couldn't handle the risk of being 100% equities. So I've always had a mix of sort of fixed income and equity in my portfolio. I don't do anything outside of these two asset classes because, to me, property is just humongously painful. I own only one property where I live in and another property where I can spend time at. I don't own anything else. I don't intend to own because the frictional cost of managing, etc., is just way too perverse. But I think financial assets, be it equities, be it bonds, be it particularly mutual funds, very easy to sort of control. Unfortunately, also very easy to sell, which creates its own problems, or even to buy because you can do it at a click of a button, right? But having said that, to my mind, these are great assets in terms of your ability to manage them easily and very simple to even transmit them, which is something you all need to be equally concerned about. That what happens, how will this pass down to my next generation? And these two assets are very simple in terms of executing that. I think the financial architecture that we have in India, digital nominations, all of that is just fabulous in terms of your ability to hold, transmit these assets. And even taxation is very favorable. I know you'll have the budget soon and all that nonsense about capital gains will come again. But the fact of the matter is, we have a very attractive regime for financial assets. So I don't know what people are complaining about, and use that advantageous regime to be long-term investors in both equities and fixed income in the mutual fund industry. It works very well. So I don't have any rocket answers for you. I only do mutual funds. I don't do equities for the reasons I mentioned earlier. So all my net worth is in this, except for my primary residence and my sort of weekend home.
What about gold? Your thoughts on gold?
So gold is a bit like an insurance policy in my view, Rahul, and it's got a very unusual outcome, right? So if you think of a world of distribution of returns, so the normal curve doesn't work, but it has these fat tails at both ends, right? The beauty of gold is that it can actually work for you at both ends of the fat, and which is why to me gold has some place in your portfolio as long as you think of it as an insurance policy. So I've never treated it as a core allocation where you hold it and sort of allow it to sort of accumulate. But it makes sense as an insurance policy because in times where things go horribly wrong, you're going to have drawdowns in all your other asset classes. This might be the only asset class which rises in value. At that time, you may want to actually liquidate that asset class and put it back into the liquid assets which have seen the draw. Right. So that convexity that it has, I think, really adds value to all portfolios. But the way to think about this is that it's closer to being a term insurance policy than it is a money back insurance policy. Not saying any insurance policy is a good investment, just, I think those are the two contexts in which it's easier to understand.
Makes sense. You spoke about thinking of inheritance and passing it on. So you mentioned you had a kid in, did you say year 2000 when everything was kind of falling apart? So how are you teaching your kid or kids about investing? And also tell us whether they listen to you.
Yeah, no, I haven't really taught them much about investing, though I've been trying to teach them something about at least how to start managing. So actually, there are two girls now, not just one. The older one has just started working. So we've been trying to get her to understand the concept of saving. And, there's a wonderful book written by somebody, most probably you know equally well, Monica Hallam. So I just gifted her book to both of them when they were here in December for their holidays and said, here's this hard copy book. Now, please take it back and read it carefully because there's a wealth of wisdom in this about, earning, saving, investing. So I think it's a fabulous sort of beginner's guide to sort of understanding basic financial planning, not investing. Investing is something they have some time to get to, but yeah, that's the basics.
That's a nice one. Thoughts on living expenses? Do you keep X months of living expenses aside to tide over phases? And how do you plan that? How do you think about that?
Yeah, because mutual funds are now sort of easily accessible in terms of liquidity. And everything that I own now is sort of jointly both my name, my wife's name, Kids are nominees in most cases, so they have enough immediate access to it. So I don't think so much about it as being liquid, because anyway you can get MF liquidity in T+1 or T+2. So don't necessarily think about it in that context in terms of having liquidity in my bank account, because I think I can access that liquidity through the MFs in 48 hours. So not a big issue. But certainly, not to take away from the point you're making, may not be so relevant to me today, but I hear what you're saying, and I know people talk about it in terms of having a money box of certain months of income available to you for any setbacks you might experience. And I think that's a good starting point for younger people, right? But I think the most important thing for younger people, and that's the only thing I tried telling my daughter as well, because she says I don't earn enough to save, is that you will never have enough to save unless you say I want to save X, and then make sure that income minus expenses is equal to that X. Because if you say I will save what is left over after my expenses, you're never going to have anything left. So that's the only thing that I would say is, the
income minus savings is what you spend, right? That's what they should. That's the typical Indian formula, right? That's how we all were. That's all our.
True.
Okay. Now, before I move to my final set of questions, which is more about reading, etc., I want you to talk a little bit about India. We've, as a country, we've had this whole early 90s reform, which was the moment, right, that India would come. Then we had the 2002, 3-4 phase, the India shining phase, where it just seemed everything is falling into place. Of course, the economic parameters adding up, not adding up, I'm not getting into that. And now we have yet another phase that is happening, and everyone believes this time it's different. So I want you to talk to us and tell us, what are you thinking about India at this point in time? And how do you see India panning out? And I'm talking, and I'm hoping you'll talk decades as against this year, next year, etc.
So, I think we have a wonderful platform. We have a platform from which there is a lot which can be achieved. And I actually worry that there's too much focus on the aggregate size of the economy. I love the fact that we are the 5th largest economy in the world, but I don't want that to take away from the fact that our per capita income is $2,500. Right? It doesn't matter to maybe 70% of the citizens of this country that you are the world's 5th largest economy, because all they're seeing is their per capita income, which is, well under the per capita average, because the median is even lower, than that number. And therefore, there is a long, long way to go. And because there is a long, long way to go, it's great because it means there is potential. Right? If you're a $40,000 per capita economy, it's just harder to sweat growth from there. So, what is the opportunity? The opportunity is your 2,500. There's a long way to go before you even reach middle income. Right now, low income. There's a long way to go even before you reach 12,000. If you can get to 12,000, imagine the quality of life your citizens and your countrymen would have. I think that's a fabulous outcome. So, I love the fact that there's so much potential, but it also means that the key to this success is execution, right? And I am a bit wary of this. This is my decade, that is your decade. If you ask me, the last 2 decades have also been brilliant decades, right? I mean, who knew that? Okay, actually they did. If you actually go back and see the BRICS 2003 report, right? Dreaming with BRICS, Jim O'Neill, Rupa Purushottam. Do you know what they said over there? They forecast over there exactly where you are today. And that 2003 forecast also says that you will most probably be bigger than Japan in 2031, which is exactly what we are saying today. So, the thing that we should feel good about is that there was a potential we had 20 years ago. We've executed that to a great measure. Maybe we could have done better, but we've executed it to a great measure. And I'm excited about the fact that there is potential to do the same over the next 20 years, which can maybe, nicely pull us up into the ranks of being a middle income country. But I am not a soothsayer. I don't have a crystal ball to tell you, whether it will be golden decade or not golden decade. All I can say is the last 2 decades have been exceptional. They've been for many of us, but I equally would submit they have not been good enough for many of our citizens. And therefore, there's lots more hard work we need to do over the next 2 decades. And just to take it back to that 2003 BRICS report, right? So the BRICS, or rather the BRIC, was Brazil, Russia, India, China. Mm-hmm. China more than achieved those targets. India has delivered those targets. Look at the other two.
Yeah, the 50-50 shot. Yeah.
That report, all four had potential. Right? Yeah. So, I always show this one sort of slide in many of my presentations, which is Steve Jobs. It says that ideas are multipliers. The idea of India is a multiplier. It's a brilliant idea. Execution is worth millions.
Yeah.
And that's where we need to deliver.
Yeah. Fair point. I like that answer. It's rooted in reality. It's rooted in all fact. There's no like crystal ball gazing, which I like. Thank you for that. Last few questions. How much time do you spend reading?
Fair bit of time, Rahul, but truth be told, it's come down over the years because, 10, 15 years ago, the only source of stuff you had, maybe 15 years ago, was books. What's changed in the last 15 years is one is the internet, right? Mm-hmm. You're able to reach a lot of content which you earlier couldn't, and you only had to wait for books to be able to do it, or maybe, of course, some magazines. But today, the internet has made a lot more content easily accessible. The other truth about books, which has taken me 20 years to figure out, is that books are still written on the basis that I must publish a 200-page book, so that is how publishers will distribute it.
Too much of a coincidence. Yeah, too much of
actually, the whole book would have been written as a 5-page essay.
Yeah.
But nobody buys a 5-page essay, right? So it has to be converted into a 200-page book. So I have actually found that the internet is now making a lot more content which can give you everything a book can, but in 5 pages or even in lesser characters. So that's become a very powerful source of information that didn't exist 15 years ago. The other thing which has changed is being able to access what you would have heard in the book, what you would have read in the book, through audio-visual. The podcasts, the YouTubes, the Google Talks, so many, intelligent people giving interviews all over the world, part of forums, and all of that becomes accessible to you. So actually my reading has come down, but, I'd say the time I gave to reading earlier is sort of cut now into, yes, reading, plus all of this information on the internet, which may be more bite-sized as compared to book-sized, and then the audio-visual content coming through the podcasts and the, video interviews on YouTube and other AV media.
I can relate to that. Can you recommend some things our viewers and listeners should watch and read, if you will, to become better at what they do in terms of investments and just life in general?
So I think when it comes to books, one of my favorite authors has actually been, he was more academician than practitioner, but Peter Bernstein. Okay. And I think both his books, Capital Ideas and Against the Gods, which is about risk, are both fabulous books. And, I read Capital Ideas when I was on campus, and I read it 10 years later. When I read it on campus, it sounded like theory. I read it 10 years after campus again, and I said, bloody hell, if I'd only followed all of this in the last 10 years, I would have saved myself a lot of mistakes. But I think he does a fabulous job of connecting the academics to practicing in the real world. So I really love his 2 books. Outside of that, I would say I'm also a great fan of Howard Marks' The Most Important Thing. I think that's a great, book to read. It's a collection of all the memos, but yeah, it's a simplified way to, sort of read that. The Warren Buffett newsletters are fabulous. I mean, his annual sort of thing, those are fabulous. Recently, I would say, the 2 most profound books I've read in the last few years, one would be Investing the Last Liberal Art. Okay. That's a fabulous book because it sort of connected the dots in a way that I've also realized things are connected over the last 20 years, which is to say, investing is not a single domain. It actually pulls in so many things from other domains, and which is why the title Investing the Last Liberal Art, because it's connected to so many other fields. So I think that's a brilliant book. And Morgan Housel's Psychology of Money, I think, great book in terms of understanding the nitty-gritty of how we take financial decisions in an emotional world and how money affects our psychology. So I think these are 2 more recent books that I really like. And of course, I shouldn't forget Phil Fisher,
Yep.
Common Stocks, Uncommon Profits. I think again, fabulous book in terms of thinking about investing as a business.
Yeah, great. My final question to you. What is the one idea you would leave our listeners and viewers with to think about in terms of investing or whatever? What do you think is important enough for them to think about?
So this is not my original line, but I've come to sort of adopt it as my own. So this is from Ed Thorpe, and I wrote an article about this in April 20 called Chance, Choice and Crisis, which was effectively borrowed out of his line. And he says, life is a combination of chance and choice. Chance is the cards we are dealt. Choice is how we choose to play them. And, I think that sort of, to me, the bulb went off in terms of the fact that that's been the way many things in my life have played out. Right. So chance are the cards you're dealt with. Choice is how you choose to play them.
Wonderful. On that note, Vetri, thank you very much for your time. It's been a wonderful conversation. Thank you very much.
Sure. Thank you so much, Rahul. Thanks for doing this.